Hey there everyone, great to see you back on the Dog Master channel. Today we're diving into a popular technical analysis pattern, the wedge. We'll break down exactly what makes up this pattern, look at the key difference between bullish and bearish wedges, and see how to apply the wedge in your trading strategy. Be sure to subscribe to learn more about how the crypto market works and how to make the most of it. Now, let's jump in. First, let's cover the basics. A wedge is a chart pattern that forms when the price starts narrowing within a range, creating a tightening triangle that points up or down. We typically see two types of wedges, the rising wedge, which is often bearish, and the bullish falling wedge. Let's start by identifying the difference between these two. Rising wedge often signals a potential continuation of a downward trend. It typically forms during a corrective upward movement, and once it breaks down, this can be a solid indicator to open a short position. Fallen wedge. By contrast, this pattern suggests a possible end to a downtrend. It often occurs during a correction in a down market, and the breakout upward marks a good time to consider a long position. On a chart, the wedge looks like two lines coming closer together near the current price. It always tightens from left to right, with the lines more spread out on the left side and converging on the right. You'll see these patterns in all time frames, which are useful for long-term and short-term trading. To make the most of this pattern, it helps to understand how it forms. Here's the deal, a wedge usually takes shape as price fluctuations tighten and the market moves into a triangle where each high and low becomes lower than the previous one. Typically, the wedge signals that the market is gathering momentum and preparing for a breakout. Now, these patterns do have their quirks, and the best way to get familiar is by actively using them. Here's what we've learned from experience. Wait for the breakout of the support or resistance level indicated by the pattern. Once the breakout happens, you'll often see a strong move in that direction, which can be a perfect time to jump into a trade. Alright, let's look at a couple of examples in the terminal. The first example, Bitcoin USDT chart. Here we see a rising wedge forming during an upward correction. When the wedge hits a critical point, price breaks downward, indicating a short position opportunity. This breakdown signals that the market is returning to a downward trend and presents a great moment to go short. The second example, in another Bitcoin USDT chart, we have a falling wedge forming in downtrend, suggesting a potential reversal. The breakout upward is the moment to enter a long position as buying pressure builds and price starts to move up. Next, let's explore two reliable strategies for trading the wedge. Volume confirmation. Check the volume after the wedge forms and the breakout occurs. An increase in volume at the breakout strengthens the signal, making it a good time to enter. Set your stop loss within the wedge to limit risk. Using RSI. If you've seen our previous videos, you know RSI is another powerful tool. After the wedge breaks, look at RSI. If it indicates oversold below 30 or overbought above 70, this can confirm the strength of the signal. This helps avoid false signals and only enter the market when the trend confirmation is strong. Well, let's sum it up. The rising wedge is used in a rising trend as a reversal signal, in a falling trend as a trend continuation signal. The falling wedge is used in a falling trend as a reversal signal, in a rising trend as a trend continuation signal. The wedge is an actively used graphic figure in trading. Using it, you can not only identify potential reversals and trend continuations, but also improve your understanding of market sentiment. If you liked this video and learned something new, do not forget to like and subscribe to the channel.